Well, I want to welcome everyone here today. Since you'll be ultimately developing business plans, an important component of a business plan is determining, gathering your financial data and making some decisions and projections with that financial data. An important piece of that, and to be able to do that, is to look at cost behavior and cost volume profit analysis. And let me back up, and I apologize. I'm Kathy Simione, and
you're not Gary Schneider?
To my right here is Gary Schneider, and we're on the accounting department faculty here at Quinnipiac. So, in order to begin to make the kind of analysis that you will on your business plans, you need to look at cost behavior. And at the two ends of the spectrum, when you look at cost behavior, we can look at variable cost. Variable cost vary or change in total, and they are fixed or they remain the same per unit. So if I were to give you an example of what I mean by variable cost, when you think about variable cost and how they behave, all our costs do not behave the same. So, going back, variable cost. They vary or change in total given a change in your activity. Okay, so what do I mean by that? Let's say that you run a bicycle manufacturer. If you make more bikes, you need more wheels for the bikes, so the total wheel cost would go up. Okay? If you make fewer bikes, you need fewer wheels, the total wheel cost would go down. That's an example of a variable cost. It varies or changes in total. Now, what does it mean that it's fixed per unit? That means it remains the same. Whether you need 5,000 wheels or 10,000 wheels, you'll still be paying the same wheel cost per wheel. Now, at the other end of the spectrum, in terms of cost behavior, we have fixed cost. Fixed cost remain the same in total, even given an activity change. So, same example, you're a bicycle manufacturer, and let's say your factory, you don't own your factory, you rent your factory. Well, whether you make 5,000 bikes or 10,000 bicycles, you'll still pay the landlord the same rent, total rent. That won't change. However, if I make 5,000 bikes, and let's say my rent is $5,000, I'm going to spread that rent over $5,000, $5,000 rent over 5,000 bikes. So my rent cost per unit would be $1. Now if I double production to 10,000, total rent hasn't changed. I'm still paying the landlord $5,000 rent, but now I'm spreading that rent over 10,000 bicycles, so it drops down to 50 cents per unit. So that's what we mean by it's fixed in total, that rent remains the same in total, but on a per unit basis it varies or changes. Because production went up, the cost per unit went down. But when production goes down, the cost per unit goes up because you have fewer units or bicycles to spread that same fixed cost over. Mixed cost. Mixed costs are a combination of fixed and variable. And what we have to do, and what Gary's going to tell you a little bit more about in a minute, is that when you're developing your business plan and determining what costs are relevant to your particular business, you will have to determine of your cost what's fixed and what's variable in order to move ahead and do the type of analysis that we're going to be looking at.
Okay, so some costs are variable, which means they're fixed per unit. Other costs are fixed, which means they're variable per unit. Clear? Sure. But a lot of costs are neither fixed nor variable. Actually, they're both. So the wheels on the bicycle are fixed per bicycle, variable in total. The cost of rent for the factory is fixed in total, but varies per unit. But what about a cost like electricity? What do you think that is? You make more bikes, you use more electricity, right? So what kind of cost would that be? Fixed? Variable?
Mixed costs.
It's a mixed cost. Why?
Because it's both variable costs and fixed.
How so?
Because depending on the number of products you're making, depends on the price that you're paying for the product.
Well, we're talking about the cost of electricity. So the cost to keep the lights on, the cost to run the machinery. So if we make more bikes, would we use more electricity? But isn't there a certain amount of electricity that we need just to keep the lights on and the place heated? And that's not going to change if we make more bikes or fewer bikes. So electricity has two components. There's a fixed component, keeps the lights on, and then there's a variable component that runs the machinery. And if we make more bikes, we use more of that kind of, more of that part of the electricity. Okay.
Think about your cell phone bills for a minute. Consider that, I realize you don't pay them, but if you think about your cell phone bills, most of you already have plans that include, does everybody have a plan that includes unlimited texting? Okay, so let's dial it back a few years, but before the day of unlimited
Well,
texting.
if you have a plan with unlimited texting, is that a fixed cost or a variable cost? They pay the same amount every month. So you send a lot of text, you don't send so many texts, it's the same price. So that's...
Now, if you
fixed
didn't have
cost.
an unlimited texting, once you hit that cap, that limit, anything over that would be your variable cost. So some costs are both fixed and variable. Back in the old days when we had landlines primarily, there was a monthly charge you paid for your landline, period. And then your out of area, long distance phone calls, that would be the variable portion. So that's what we mean by mix. There's a component of fixed and a component of variable.
And it turns out, although there are a lot of costs that are variable and a lot of costs that are fixed, most costs are some combination of the two. And mixed cost is one combination of the two. So when we want to do analysis, instead of, like if we wanted to get a handle on variable costs, we'd look at those bicycles, say each bicycle takes 2 wheels, each wheel costs $3. What does it cost? What's the variable cost for each bike? $3 a wheel, 2 wheels, it's $6 a bike. So it's fixed per bike, but how much was going to cost us for wheels for next month? Well, you can't answer that unless you know how many bikes you're going to make, right? So it's variable in total, fixed per unit. And a lot of costs are fixed, like the factory rent, but so what we have to do when we get one of these mixed costs is we have to figure out some way of sorting them out. And we've got some ways of doing it. The first way is the engineering approach. Let me move that slide. And the engineering approach is where we use things that we know about the cost structure. An example is rent at a store in a shopping mall. Now, you might not know this, but if you ever decide to open a store in a mall, you'll sign a contract where you pay a rent that's $5,000 a month plus some small percentage of your sales. And the mall uses that to do general mall advertising and promotion. So the idea is if your store makes a lot of sales, you're getting a benefit of their general advertising, so you need to pay for that. So that's why they build that in. So it might be 0.5%, some small percentage. But your cost for rent becomes a mixed cost. It's got a fixed component and a variable component, and we can tell what those are by looking at the contract. Same way we would with the cell phone plan, where you pay a fixed rate for a total amount, a guaranteed number of texts, and then anything over that you pay per text. So we could look at the contract and predict what the cost would be. Now, in other cases, we can't do that. What we'll do is we'll record the cost and the activity on a graph like this. So we'll have a bunch of dots. And then we'll draw a line through it. Now, one of the ways to do this is to actually plot the dots on a piece of paper and draw a line. Now, once we draw that line, we know some things about that cost behavior. For example, we can calculate the rise over the run. You've all had algebra, right? So the slope of a straight line is the rise over the run. Now, in accounting land, that rise over the run is the variable cost per unit. And then we also look at where it hits the y-axis, in this case the dollars, and that y-intercept is the amount of the fixed cost. So all that stuff you learned in algebra that you weren't sure you'd ever use, here it is.
And a little graphing to be included. And in regards to those fixed costs, remember that that's the zero activity point. So even if you're not making a single bicycle, you still have to pay the rent. So that's our fixed cost. So if we were to draw a line, a horizontal line straight across from that point, that's our fixed cost. And in that margin in between the fixed cost and our total cost line, and that's that line of best fit, so to speak, those represent our variable cost, because that's, again, your total cost line. The issue with this method is that it's basically a visual fit. It's an eyeball, as Gary referred to it. And the issue with that is that, you know, everybody's going to draw that line somewhere different. So it's not the most accurate method.
Right, if I gave you those dots and said, and had each of you draw a line that sort of captured those dots the best, we'd all get slightly different lines. And so we'd come up with different estimates of the variable cost per unit and fixed cost. So we'd each have a different idea, which isn't the best thing. So what we do is we use a mathematical technique called regression analysis, where we pop the values of those data points into, say, Excel, and tell Excel to do a regression, and Excel would give us estimates of that line. Now, you know the equation of a straight line, right? Y equals mx plus b. You've heard that before. Sort of familiar? Some of you? Okay. So in accounting, we take y equals mx plus b, and y is the total cost, m is the variable cost per unit, and the b is the fixed cost. The x is the number of units. So we have a functional relationship between the x, which is the number of units, the number of bicycles that we're making, the number of tables we're making, the number of text messages that we're making, and the total cost. So that's how we do it.
Okay, so if we could just go to a simple example. Arnie's having a party, expects between 30 and 20 guests. The soda costs $1 per can, and guests will consume 1 can each.
We've made some simplifying assumptions here.
But
But as long as on average we're close, this will be accurate.
Right.
One of the things about what we're talking to you about here today is that this isn't like the kind of accounting where everything's precisely correct and the auditors come in and verify it. This is the accounting that managers use or entrepreneurs use to plan things. And so we're just kind of roughing it out. We're estimating. So we'll be off a little bit, but that's okay. We're just trying to get a rough idea of how things are going to work out.
And we'll identify the fact that these schedules that you would go through, calculations, and even the income statement that you'd be preparing for this analysis, it's for internal purposes. As Gary mentioned, it's for decision-making, internal purposes, you know, for management to run the day-to-day sort of operations. So back to the example, you can return the soda for a refund. We have a monster pizza that will serve 20 guests, and that costs $40. You can't return the pizza or use it otherwise.
Now, before we go to the next slide, who can tell me what the variable cost and the fixed cost is here?
The variable is the soda.
The variable is the soda because, and you knew that why?
Because since we get refunded, it's like just having exactly enough.
Exactly. So if 14 people show up, what's our soda going to cost us?
$14.
If 10 people show up?
$10.
Yeah. So you're doing that calculation already. Pretty easy, right? Okay. Now, the fixed cost is the pizza. Now, fixed costs, and here's something interesting. Fixed costs aren't fixed indefinitely. So fixed costs are fixed within a range. For example, the monster pizza that serves 20 guests, that's a fixed cost within what range of guests? Like what happens if 25 people show up? We need another pizza. We buy another pizza, what does that cost? It's another $40, right? So for the range that we're interested in, which is from 1 guest through 20 guests, the fixed cost of the pizza is $40. If we go outside that range, we got to do some other calculations. So that idea of relevant range. Now, what if we had like 500 people? We could probably go to the store and get a better price on the soda. So instead of paying $1 a can, maybe we pay 90 cents a can. So the variable costs can vary per unit in the long run, and the fixed costs aren't fixed in the long run. Now, if we were economists, we would worry about that stuff. We would worry about what happens when there's very few or a whole lot. Like, what happens as we approach infinity? But we're not economists, we're accountants. We just solve actual problems. So if we can get a range of what we're interested in, we could do the analysis within that range. Now there's a side benefit to that, and that side benefit is this. If we set a relevant range within which our costs behave in a linear fashion, that is, the variable costs are fixed per unit, the fixed costs are fixed in total. If we stay tight enough in that range, we can do our analysis with algebra. If we go outside that range, where the lines start to bend, you guys know what kind of math you get to use if you have lines that bend?
Quadratics.
Well, algebra doesn't work anymore. And quadratics only work if it's a certain kind of bend. For the general bending, if you have lines like this, you have to use calculus. So we get to avoid using calculus, which is a good thing, right?
Right.
Okay.
So one thing that I should mention, and this goes to what Gary was just saying, is that the type of planning that we're talking about here is more short-term. So you have this relevant range, this capacity level, so to speak. But once you go outside of that range, or outside of that capacity, our variable and fixed costs don't behave the way we're telling you that they behave.
Yeah, in other words, the model that we're coming up here is for Arnie's party. It's not for all parties, anywhere in time, in the vast time-space continuum. Okay, this is just Arnie's party, and it's for guests from 0 to 20, and and our assumptions have to be valid. So we have to be able to take the soda back for a refund. That's a key assumption. So everything we're going to do here is based on these assumptions.
So as you're developing this piece of your business plan, you'll have to make your key assumptions as well. So,
which isn't hard to do because you kind of know how many you're going to sell or what kind of production you're looking at.
Well, we've already identified that soda is a variable cost. It would be $1 per guest. The pizza is the fixed cost. The pizza cost per person would go down as more people attended Arnie's party, up again to that relevant range capacity, which is a max of 20. So how much will Arnie's party cost? Again, it's going to depend on how many guests come to the party. So if we take a look here at the analysis.
Now we didn't calculate all of them, but we just sort of picked, like, say, what if 5 people show up, what if 10 people show up, what if 12 people show up, to give you an idea. This was done on an Excel spreadsheet.
Here's the thing, if you look at the very bottom, the cost per guest, look at what happened as more guests attended. And we're at the max. We're at the maximum of 20. The cost per guest is only $3. Why did it go down? What happened? More people, and what happened to the cost because of more people? Which cost specifically?
The fixed cost was per person smaller.
Exactly, the $40 for pizza in total. Remember, it's $40 for pizza for a maximum of 20 people. Now what we're doing is if we have all 20 people come, then we get to spread that same $40 pizza. That hasn't changed. That's the fixed component, fixed in total, but on a per unit basis, it varied or changed. It actually went down because we had more people to spread that same total fixed cost of the pizza.
So the total cost goes up, but the cost per guest goes down. Until you get to the 21st person, at which point you got to buy another whole pizza. So that 21st person is very expensive. Keep that in the back of your mind. We'll show you something that kind of works like that. Any questions? You all see how this worked? Could you do these calculations? you think?
Now, if we threw in a few other variables, such as there might be a rental fee, and there might be a cleanup fee as well. So again, these might be other types of assumptions that you might add to your own analysis.
So the cleaning fee, or
Sorry.
go back. So this party hall rental fee that's $50 plus $2 a guest to clean up. How would you build that into this analysis? It's a mixed cost, $50 fixed, $2 variable. What would you do?
Add the you add the variable cost of $2 to the $1
Right.
per soda. And
So the variable cost goes from $1 to $3.
and you add the fixed cost of 50 to the $40 per pizza.
Okay. So we would just add the $40 would become $90, and the $1 per guest would become $3 per guest. You could, actually, if this were an Excel spreadsheet that we had here, we could just change one number, copy it across, and be very quick. Accountants love Excel. It saves all that calculation. Okay.
So this is getting back to that whole relevant range concept, that the definitions for variable and fixed cost in total and on a per unit basis hold true within this relevant range. Just to give you another example, let's say that you're going back to the bicycle example, you're manufacturing bicycles, and you use machines to manufacture bicycles, and you rent your machines. So we have 3 machines that we're using. We've done a market analysis, and we find that there's the market size has grown, and therefore we can sell additional bicycles. But in order to make additional bicycles, we have to rent that 4th machine. So now our fixed costs in total have gone up. And that's because we're outside of that range. That relevant range was the capacity of the 3 machines allowed us to make, but now we need that 4th machine. So once you go outside of that range, our definitions for fixed and variable do not hold true. So you're going to make your assumptions within a relevant range when you're preparing this portion of the analysis.
And one of the problems that happens when you set up this relevant range is you've got to sort of decide like a minimum number of bicycles and a maximum number of bicycles, or a minimum number of guests and a maximum number of guests. Now, some costs that are fixed costs, in other words, they kind of hit a level and stay there, like pizza, and then we get the 21st guest, we got to buy another pizza. So those aren't exactly variable costs, but they're not exactly fixed costs either if we don't match that relevant range to exactly that cost behavior. And since we usually have a lot of different costs, I mean, this is a pretty simple example, right? So we usually have a lot of costs, and if the fixed behavior of the cost doesn't fit the relevant range precisely, we end up with a very odd kind of cost that turns out to be very hard to build into our analysis. It's called a step variable cost, and it's actually more of a step fixed cost. It varies in steps. So the example would be the pizza. If we started talking about guests from 0 to 100, that pizza cost would be $40 for the first 20 guests. Then it would be $80 from 20 to 40. And then it would go up $40 for each next 20. So you can kind of see how, you know, it would start out here and then it would go here. Now it doesn't go up like this. It doesn't curve or anything. It doesn't go up in a straight line. It goes straight, stops, jumps up, and goes like this. So it actually looks like a set of stairs. So that's what we call it, a step variable cost. And usually what we do with those costs, because it's very hard to do, and even calculus doesn't help us do that, because if you think about trying to build a calculus function even over a set of stairs, it's not a continuous function. So that creates some problems. And what we do, being good accountants, when we run into a problem like that, is we kind of, we cheat. What we do is we take that cost, throw it in with a bunch of other mixed costs, stir it up a little bit, and do the analysis on those costs as a whole, and sort of tease out a variable and fixed approximation that kind of captures the behavior of that group of costs. Okay?
So if you want to look at a graphic summary, you can see how our fixed costs behave. And We think that it always is easier to firm up a concept by looking at a graphic illustration. So,
Our students don't always agree, but we think it's a great idea. A
so
picture.
again, you see your dollars here and your units, and as you know, would provide more services or make more bicycles, as the case may be,
or use more electricity or send more text, anything that you're costing.
your total cost remains the same. That's your fixed cost, again, within that relevant range. Your variable cost would increase in total given a change in that activity, number of services, number of units, whatever the case may be. Our mixed costs have a component of fixed and variable, and then you see the step variable, and in essence, they do look like steps.
And the difference between the variable cost and the mixed cost, because they look kind of the same, the difference is that variable cost, if you draw the line straight down, it hits the origin with the X and the Y. It's not exactly drawing correctly there, but the difference between a variable cost is at 0 level of units, the cost is 0. With a mixed cost at 0 level of units, there's some cost associated with that. So that's the difference. So if you kind of think of a fixed cost with a variable cost stacked on top of it, that's what a mixed cost is. And that's kind of what we were telling you it was. Okay.
So if you were to look at contribution margin, so how many of you have been working with income statements? Do you know what I mean when I say an income statement? Have you seen one yet? Any financial statement? That's just a couple of you? Well,
let me
a
talk.
contribution
We should probably
margin.
talk about what those financial statements look like.
Oh, let me skip ahead then for a minute.
Okay.
You'll be developing, I would imagine, financial statements ultimately for your business plans. You'll be developing an income statement. And an income statement is basically a profit and loss statement. That's where you're going to show your sales minus all your cost and end up with your profit figure, or we refer to it as net income.
So just look at this column right here for now.
And I'll get into the breakdown of the cost. You'll also likely be preparing balance sheets. Balance sheets will have the assets, and the assets are what you own, basically. Your liabilities are what you owe, and your equity, that's your ownership interest. So that's a balance sheet. Possibly you'll be preparing cash flow statement, which basically shows us where's the cash, where did it come from, and where is it going to. So it tells us a story. That's what all our financial statements do, basically. They tell us a story about the company. At the balance sheet is this picture in time of what I own and what I owe, basically. My income statement tells me about my profitability, and my cash flow statement tells me about cash in and cash out, to simplify it. So if we were to look at the traditional income statement, that's our GAAP income statement. GAAP stands for Generally Accepted Accounting Principles. And these are the standards that guide us in accounting. Today, that's changing as international standards come into play. But we're bound by GAAP right now. And they're the reason why financial statements look the way they do. And if you'll notice, COGS stands for Cost of Goods Sold. So the way our traditional or GAAP statement, income statement, is put together is that we split our costs really by function. And by that I mean cost of goods sold basically represent my manufacturing cost, and GS&A stands for General Selling and Administrative. That basically represents my non-manufacturing costs, my selling expenses, my administrative. Or you might refer to them as product versus period cost, because that cost of goods sold, those manufacturing costs, end up getting expensed when you sell the product. So that's our traditional income statement. In a contribution margin format income statement, which is the type that you'd be working with for your break-even analysis and your cost volume profit analysis, would be splitting your costs not by function but rather by behavior in the two components that we've been talking about, splitting your costs between variable and fixed. So in that variable component, is not only the variable manufacturing, but the variable non-manufacturing, that's variable selling and variable administrative and general type of cost. And your fixed cost, again, includes all fixed cost, fixed manufacturing, and that fixed non-manufacturing component as well. So what it does now is, you notice we have that subtotal, CM, which stands for contribution margin versus gross profit. How is this going to be more useful for our managers? Well, remember how we were talking about how fixed costs behave? When you're talking about the manager can't influence in that short term, in that relevant range, really can't have much influence over those fixed costs. No matter how efficient they are in that department, they're still going to have to pay the same rent. So by splitting the cost between behaviors, it's going to be more useful to the manager, and then we're going to take it and show you how you can also use it for break-even.
Okay, so the costs that we have in the gap statement are the costs by function. So when you look at that, we start with the revenue, and we subtract the product costs. And the product costs are direct materials, that's the DM, direct labor, that's the DL, and manufacturing overhead. Now, direct materials are anything that goes into the product. So if we're talking about making those bicycles, it's the wheels, it's the tubular steel, it's the chain, the seat, the handlebars. So anything that we make or buy to put this bicycle together is a direct material. And we keep track of it. In other words, we'll keep track of the wheels if we buy them from somewhere else. We'll keep track of those wheels, and we'll keep track of which wheels go on to how many bikes. And we'll also keep track of, like, if one of the rims is bent and we have to throw it away, we'll keep track of that. So we keep track of the direct materials pretty carefully. Then the direct labor, the DL, that's the work that's done to actually fabricate and assemble, put the bikes together. So we have a lot of people working for us, and they do a lot of different things. The people that work for us that actually fabricate and assemble the bike, they bend the steel, they do the welding, they put the bolts on, so they hook everything up. So we keep track of those people, how much we pay them, and what time they work on that. So if you go to work in a bike factory, you might spend 37 hours a week assembling bikes, and then you might spend another 3 hours sweeping up the floors or checking inventory or doing some other things. So when you fill out your time card, you'd have to fill out at the end of the week that you spent 37 hours assembling bicycles and 3 hours doing other stuff. And then the accountants would sort that out, and they'd put the cost of paying you and your benefits of the 37 hours would be direct labor. And the other 3 hours would go into another little bucket that we keep for this kind of stuff. It's called manufacturing overhead. So the third cost up here, the manufacturing cost, is manufacturing overhead. It includes all of the materials that aren't direct materials. It includes all the labor that isn't direct labor. And it includes something that I think the correct technical term for it is other stuff. So all of the things that you need to keep the factory operating, the electricity, the rent, insurance, property taxes, the green stuff you sprinkle on the floor and sweep up when some kind of oil spill occurs, all of that. The cost of the person sweeping up the floor. They're not assembling bikes, they're sweeping up the floor. So if you sweep up the floor, you're a part of manufacturing overhead. If you assemble bikes, you're direct labor. So we sort all that out. And so what we end up with are a couple of really pure costs. And when I say pure costs, I mean that their behavior is pretty easy to determine. The direct materials and the direct labor, because of the way we kind of are very careful about accounting for them, turn out to always be variable costs. So the direct materials to put a bike together are fixed per bike, variable in total. How many bikes did you make? So it's like the wheels on the bike, the frame on the bike, the seat on the bike. Those are all direct materials. They're variable costs. Because of the way we account for direct labor, it becomes a variable cost too. Now you might be thinking, well, wait a second, when we hire people, we pay them for 40 hours a week, whether they actually assemble bikes or not, right? Because that's how you get good people. You got to guarantee them some hours. But the way we handle it internally is, if they work 40 hours, but they don't spend 40 hours assembling bikes, the time that they don't spend assembling bikes, we peel that out of direct labor, throw it into manufacturing overhead, which really messes up manufacturing overhead, but it keeps direct labor nice and clean and makes it absolutely a variable cost. So now we've got this manufacturing overhead bucket. It's sitting over here with all the junk that we threw in there, the materials that aren't direct materials, like some things, like nuts and bolts, we might not want to keep track of. If there's a material we don't want to keep track of, we throw it into, it's indirect materials, we throw it into manufacturing overhead. Okay? So manufacturing overhead ends up as, what would you call it, like the garbage bucket?
For all the product cost. If you determine that it's a product cost, and by product cost I mean if you determine that it's related to the factory, to the manufacturing process, then it goes into the product cost category. And if it's not direct material, and if it's not direct labor, it's going to be in manufacturing overhead.
Now what kind of cost would that be? How would that behave, that manufacturing overhead garbage bucket, where we throw everything?
Is it fixed, variable, or?
Something else.
Mix.
It's
There's
probably
both.
a mixed cost. Now it's got a lot of junk in it. It's got some variable stuff in it. It's got some fixed stuff in it. It has step variable costs in it. And it's got some costs, like that cost of the labor that we peel off because it's not direct labor. That's actually kind of an inverse behavior variable cost, because as the production goes up, it goes down sometimes because you don't have time to sweep the floor so it doesn't get swept. So there are a bunch of oddball costs. And what we do is we throw them all into one bunch, run a regression on it, and estimate it into a variable and fixed component, and forget that it was ever a mess.
So the rent for the factory, the insurance for the factory, the property taxes for the factory, those are all part of manufacturing overhead, and they behave how? Those three costs? In what manner do they behave?
So you have rent, property taxes, insurance.
Right.
So if I make more bicycles, what happens to rent, property taxes, and insurance?
Per bike it lowers.
I'm sorry?
Per bike it lowers.
Per bike it lowers, what happens to the costs in total?
Stays the same.
They're not going to
Stays the
change.
same, so there you go, three fixed costs, okay? What else is part of manufacturing overhead? Those supervisors you saw on an earlier slide, those factory supervisors, they don't directly work on the product, but they are part of the factory or product cost.
So they're not direct labor.
So they're not direct labor, so they're part of manufacturing overhead now. What do you think about that? Is that fixed or variable?
Supervisors.
The supervisor's salary.
How many supervisors do we have?
4.
Well, if we made more bikes, wouldn't we need more supervisors? So would that be a variable cost? Can we buy supervisors by the hour, or do we buy them by the year?
Not a trick question.
I thought it was pretty tricky.
So
See,
what do you
if we can buy supervisors by the hour, they're a variable cost. If we buy them by the year, they're a fixed cost, as long as we always have 4 of them. But if production goes down, we won't need 4 of them, we'll lay a couple of them on.
And this...
But if production kicks up, we might need 2 more.
This brings up an important point. Don't make an assumption based on something that we might tell you that, you know, in our example we're giving you, our supervisor is a fixed salary because no matter how many bikes you make within that relevant range, they're still going to get paid the same. Okay? But in your situation, you might be making different assumptions, so don't take a cost and say this is always fixed, because in certain situations some costs are fixed, some costs are variable. You have to look at how that cost is behaving given as that activity, whatever that activity you may have, given that activity changes. What happens to the total cost? So we can't just make, you know, a general statement, a broad statement about how some of these costs behave, because in some situations they behave in a variable manner for one company and a fixed for another, and vice versa. There are some costs that are, again, going to be fixed, but try not to make those assumptions. Be careful about that.
But what kind of cost was that supervisor's salary? I'm confused.
Well, it depends. If that supervisor was paid on an hourly basis, then it certainly would be a variable.
No, we pay him a salary.
Okay, then it's fixed within that range. But if we have a situation where we have a supervisor for every, let's say, 10 employees, and now we add one supervisor, we add 11, 12, 30, we're now up to 20, have to add another supervisor, guess what happened? Now we have that step variable, or step fixed, as the case may be, because the step is a little wider when we talk about a step fixed.
So
We
there's step
enjoy
variables.
this, so.
We could talk about this all day, just do this.
Okay, so here's an example. Charlie's Chair Company makes leather chairs. Here's the cost structure, and again, you can see the reference. Cost structure refers to, we're talking about unit sales price, unit variable cost, and total fixed cost.
And if we know those three things about an activity or product, we can do some very interesting things. We can plan, we can figure out at what point in selling those we'll break even. We can figure out how many we need to sell to make $10,000 a year. We can even figure out how many we'd have to sell to make a net income that's 10% of whatever the sales is without even knowing what the sales is.
And just to go back for a moment, that general selling and administrative expenses, if you were a large corporation, you'd think of that as your corporate headquarter costs. Okay. So some of those same costs that you would have for the factory, the electricity cost and maybe the rent and the insurance, but if it's on that corporate headquarters, then it's that general selling and administrative category.
So those can be variable or fixed too.
Yes, absolutely.
And most of those are mixed, and so we have to split them up.
So if we were to look at the selling component of that, you look at advertising. Advertising is a fixed cost. It's not variable. People tend to think of it as a variable cost.
Because you
but-
can pick how much you want to spend, right?
Exactly.
But once you pick how much you're going to spend this year, it's a fixed cost.
Now, a variable selling cost would be a sales commission, is the classic example. So, moving back, so the non-manufacturing or the selling general and administrative component of cost, the variable selling is $50 per chair, and the fixed selling and admin is $5,000, and there are the facts in terms of your selling price, variable and fixed manufacturing cost. So, using this information, we can create those two financial statements, the traditional GAAP financial statement and the contribution margin format of income statement. And the volume is that they sell 100 shares.
Okay, so you might look at these and say,
Excuse me.
so what? I mean, if we use the financial accounting, the GAAP basis statement, we have sales of $80,000, that's 100 shares at $800 a share. The cost of goods sold is $450, that's the variable manufacturing cost, plus $20,000, which is the fixed manufacturing cost. So we add those together and get $65,000. We calculate a gross profit of $15,000. Our selling and administrative expenses, that $50 a chair, think of that as either a shipping cost or a sales commission or a combination of the two. So $50 times 100 chairs plus the $5,000, that's the depreciation on the President's Mercedes and that kind of important stuff. So that's $10,000, so we have a net income of $5,000.
And you'll notice on the contribution basis, the income statement begins and ends exactly the same way. I'm going to have the same profit, my bottom line net income is going to be identical, my sales is the same. The difference is how we distinguish cost. Again, we're just splitting our cost between behavior, fixed and variable, as opposed to by function, cost of goods sold versus general selling and administration. So the variable cost here, the $50,000, refers to the variable manufacturing of $450 a chair times the 100 chairs and it also is that variable selling of $50 per chair. And the fixed cost includes all fixed costs, the fixed manufacturing and that fixed non-manufacturing, or that fixed selling in this case.
And when I practiced accounting and I would show my clients this kind of breakdown, they would look at me like I was some kind of weirdo, because they'd say, well, that's all well and good, and I'm sure it entertained you to do this, but all you've really done is move the numbers around. I mean, I'm selling the same amount, I'm making the same amount, what's the big deal? Are any of you thinking that? Like, what's the point? I mean, clearly Gary and Kathy can have fun all day sorting these numbers out different ways, but what does it actually mean? Well, it turns out that it does mean something.
Right, and what you're going to be able to do is, as Gary mentioned a little while ago, you'll be able to make the kind of analysis to say, you know, what's the bottom line in order to just break even or to achieve a certain targeted profit? Given what my cost structure is, how many units would I have to sell, or how many services would I have to provide? If sales were to go up by a certain percentage, what happens to my net income? What happens to my profit, in other words? So that's what this type of the contribution margin format of income statement helps you to do. So if we look here and go back to this traditional GAAP statement, you know, the problem with this statement, it provides us with information about the company's profitability, certainly, what their sales were, what their costs were by function. But I'm not able to look and understand what is the company's cost structure, nor do I know how many units. Can I use this information to determine how many units does this company need to sell to achieve break-even, to achieve break-even, the point at which total cost equals total sales, to achieve that point, or to achieve a certain targeted profit, whatever that targeted profit might be.
So if you go to the annual report of any traded company, let's say Ford Motor Company. Now, Ford Motor Company makes cars, right? You know that. So you look at their financial statements, and let's say, we can add some zeros, but let's say it looks like this. So we know that their cost of making cars is 65, let's say, million. But what happens, and we're looking at their published financial statements, and let's say I'm a stock analyst and I want to figure out if Ford's a good company to buy. This is all I have. I never get the breakdown of the contribution margin statement. Ford will go to great lengths to prevent anybody outside the company from finding out what its cost structure is. Now, people try and estimate that, but they're just estimates. It's very, very carefully guarded information. Why? Well, if I knew how Ford made their cars and what they paid for different elements of their production process, I could go into the car business and compete against them. It's valuable information. So they won't disclose it. So if this is all I have to go on, and I wanted to say, what if their sales doubled next year? How much money are they going to make? $10,000? No. Because if they double sales, the cost of goods sold will go up. How much will it go up? Will it double?
And remember, costs behave in different manners, so we can't say that the cost would double.
Yeah, the cost of goods sold includes variable costs that would double and fixed costs that won't change at all. How much of each is in there? We're not telling you. Ford's not going to tell you. Trade secret. Don't want you to know.
But, on the other hand, if we had a contribution margin format of income statement splitting our costs between variable and fixed by behavior, then we could get that type of information. So here's what we do. If we make the assumption that our selling price per unit and our variable cost per unit remains the same, then what we can do is we can calculate our contribution margin ratio. And that's basically the percentage our contribution margin is of your sales. You can think of your income statement, your sales being your top line, and that's 100%. And everything else on your income statement is going to be a percentage thereof. So our contribution margin, $30,000, is what percent of sales of 80,000? It's 37.5%. Well, what we can basically do is, using that, we know that if sales goes up by 10%, because we've now split our variable cost and our fixed cost, well, your variable costs are going to increase along with your sales. So variable costs will go up 10% as well. Fixed costs, remember, in total, they're going to remain the same. So if that happens, now I can look at the effect on net income. Well, sales is going up by 10%, so variable costs go up by 10%. In other words, contribution margin goes up by 10%. No change in total fixed cost. So there you go. I can come up with my new net income, which is going to be an additional $3,000, or it's not going to be $8,000.
So income goes up $3,000, not 10%, which would be $500. It goes up a lot more. Interesting.
So obviously, knowing how our cost behaves allows us to do the kind of short-run planning that you'd be doing for your business plans, to be able to, again, make your assumptions and then do your analysis, determine what type of profit you'd like to be operating at, or are you working at the break-even point, and whatever your other targets are. We can do this kind of analysis. You can look at, it's great, you can look at what-if scenarios. You know, what if sales drop off? What happens to my profit or my net income at that point? What happens if we make changes in sales, increases? What happens if, even if a change in variable cost per unit, how would that affect the bottom line profit? So you can make that kind of analysis using our contribution margin format of income statement.
So this is a general format of that statement with X's instead of actual numbers. So now we're going to develop a general model for this. And if we look at this, it's sales minus variable costs equals contribution margin minus fixed costs equals net income. Now net income at break even is 0. So if we write this as an equation, set X, the bottom X, equal to 0, move some terms around, we can come up with some very useful formulas. So if we take that stacked income statement, turn it sideways, we'd say that sales minus variable costs minus fixed costs equals net income. Or, since sales minus variable costs is contribution margin, we can just say contribution margin minus fixed costs equals net income. Now we can also state contribution margin as contribution margin per unit times the number of units. Because the selling price is fixed per unit, the variable costs are fixed per unit, so if you subtract one from the other, you get a number, contribution margin, that's fixed per unit. So once we get to this, we can say at break even, net income is 0. So the net income over on the right side there becomes 0. And with a little algebra, we just take contribution margin per unit times units minus fixed costs equals 0. We add fixed costs to each side, so fixed costs minus fixed costs on the left side, that goes away, and fixed costs appear on the right side. And then we divide through by contribution margin per unit, and we come up with a formula that's fixed costs divided by contribution margin per unit gives us the number of units at break even.
So this is your break even calculation, and it may seem that we got there in a complicated fashion, but it is basic algebra, as mentioned, and it stems from the profit equation. It stems from the fact that if you take your sales and you subtract all your costs, you end up at your profit figure, your net income. And that's just that carried out. Okay? So if anything else fails, you can always go back to your basic profit equation, because that's where this stems from.
And here are formulas that we've derived from that. The first one is the break-even sales in units. That's what we just derived. We can also do the break-even sales for dollars, and we do that by dividing the fixed cost by the contribution margin percentage, which was the number we calculated for Charlie's chair company. The derivation is exactly the same. We go through the same process, the same steps we had on the previous slide, except instead of contribution margin per unit, we express contribution margin as a percentage of sales. Now, we can also, let's say we don't want to know what it takes to break even. Let's say, I don't want to break even, I want to make $100,000. If we just add that target net income to the fixed cost and divide by contribution margin per unit. It'll give us the number of units that we need to sell so that after we subtract our fixed costs, we will end up with exactly $100,000. And then a more complex formula is the one where if we want to make 10% of sales, not knowing what sales are. So we're saying, how much sales do we need to make so that 10% of whatever that number is turns out to be net income? We can use this last formula. And basically what we're doing there is manipulating the element of variable costs in the contribution margin percent. So some examples. Let's go with the cost structure. It's a little bit different numbers. We have a selling price per unit of $500, variable costs of $300. What's the contribution margin? Selling price is $500,
For one
variable
unit.
costs are $300. What's the contribution margin per unit? $200, okay. And the fixed costs are $50,000. So we calculate the contribution margin, $200. We can also calculate the contribution margin percentage. So the contribution margin is $200. What percentage is that of the selling price? And it's 40%. So if we want to know how many units we need to break even with this cost structure, it's 250 units. We can also calculate the sales at $125,000. Now, one of the interesting things we can do, if we know the 250 units is the break even, and we know the selling price per unit is 500, we can skip this bottom formula because 250 units times $500 per unit is how many dollars of sales? It's 125,000.
So anything above 250 units, we'd be making a profit. Anything below 250 units, you'd be sustaining a loss. And the same thing with the $125,000 sales.
Questions? We haven't asked them questions in a while. They understand it perfectly. We've done such a great job.
So here's an example of checking your break-even calculations. You can go back using the same example. We said that the break-even point in sales dollars was $125,000. The variable costs, remember they were $300 a unit, and we were talking about 250 units at the break-even point, and there you go. Look at that. So you can test it out, go back to your contribution margin format of income statement, test it out, and see that this stuff actually works.
Do you have a laser pointer on that thing? No?
No.
Okay.
Okay, so here's a little more practice, but at this stage, do we want to give them, we don't have a lot of time left, and I'm wondering if we want to jump ahead here and then try that example?
Sure.
Okay? Why don't I give this out while we're... like anything, cost, volume, profit is wonderful, but there are some limitations. I'll let you take it from here, Gary, while I distribute.
Well, we've talked about most of these limitations. First of all, we're assuming that the revenue and the cost behavior is linear. That means that, again, the selling price stays the same, that the variable costs are fixed per unit, and the fixed costs are fixed in total. We also assume that the fixed and variable costs can be identified and separated. So we can actually figure out what they are, and then we can use those to predict. So all that stuff about estimating costs is really important. You have to have that before you can do this. Another one thing that we kind of that's kind of built in here is the idea that productivity and efficiency don't change. And that's important because what if our workers got better at doing the bike assembly? What would that do to our costs? They would make the bikes faster, they would use fewer hours, we're still paying them the same amount of money, so our direct labor cost would drop. And what would that do to our break-even calculations? If our cost estimates are off, then we have to revise those. Now, in our more advanced courses, we teach something that have you ever heard of a thing called a learning curve? That as you do something, you get better at it? So we can actually build into this model a learning curve over time. That's a little bit fancier arithmetic than we want to get into today. So we can't account for that, but our basic model assumes that
Oh, I'm sorry.
I got rid of my slide. That productivity and efficiency don't change. We also assume that selling prices and costs are certain, that we know what it is, and this is a biggie. We assume that the firm sells a single product. Now, there are variations of this that we can use if we do some estimating with multiple products, but this technique is very, very good if you're starting a company and you're going to make one product. You can use this to establish your break-even and do your business plan projections based on that. So it's very useful for focused manufacturing, for providing a very similar service. So any kind of, and a lot of entrepreneurial kinds of businesses are like this. So if you're doing a business plan and you can boil it down to one product or one product mix, then this works. If it gets more complicated than that, then this falls apart. And you can use this along with some other things to make estimates, but as a basic analytical tool, it falls apart. Okay.
All right, so.
So this wouldn't be worth anything if we couldn't actually do some analysis, right? So we're going to help Mary, who sells hot dogs in Manhattan, figure out what a break-even point is and some other things.
So that's the example that I just gave you. Give you some calculators and put you to work.
So when you're starting on this, you want to figure out what Mary's variable costs are, what her fixed costs are, and what her selling price per hot dog is. Let me know if you have questions.
Does anybody need a pencil? Did I give them a solution? No. I don't think so, did I? Oh, yeah. Okay.
Question?
I came in late, so I apologize if you have a little bit of stuff. When the kids start and they decide on their one business that they're going to be doing for the e-commerce, and they're going to prepare an income statement, should it be for the period of time? Should it be 1 month? Would you recommend a year? Because an income statement covers a period of time.
Yes.
So would you recommend that they, and we're making assumptions as well.
Right.
We're assuming we can sell this much of our product or service.
Right.
In a 1 month, and maybe the projection might be more accurate if you're just going into a month as opposed to a year. Would you suggest that?
So it depends on how fancy you want to get. If you're doing a standard business plan for something like a small business association loan, they'll ask you for monthly projections for 5 years. So you'd want to do a monthly projection. You want to do 60 months projections.
And by month by month?
Month by month.
So what our income would be?
Each month, right. And the reason that they do that is when you first start out a business, you're probably not going to sell very much. So they want to see how much you're going to sell in the first month, the second month. What do you think? How do you think the sales will grow? At what point will you hit break even? At what point will your fixed costs be covered? You know, those sorts of things. So that's what they're interested in seeing.
And then the break even, that's not really over a period of time, like income statement. That's just for how many pieces of your product you need to sell or your service to just not make a profit or loss.
Right.
It's not saying it's a month's time or what, it's just.
It's over, it's as of a given point in time, given your cost structure, this is what you need to sell in order to reach that break-even point.
Right.
So,
What you could do is you could calculate a break-even point and then show your sales forecast. And let's say your break-even point is 10,000 units. So you have a sales forecast. Your sales forecast says how many units are you going to sell in the first month? Well, we're only going to sell 500. What are you going to sell in the second month? The second month we're going to sell 1,000. The next month we might sell 2,000. So at some point your accumulated sales will hit the break-even point, and you will say, if we start in January, we will hit break even in August.
Okay, so it's helpful to say when we're going to hit this break even, not just.
Yes, anybody that's going to lend you money would be very interested in knowing when you're going to break even.
They need to know the timeline.
Yes, yes.
So despite leaving, well, when will you get there?
Right. And the reason for that is if somebody's investing in your company, they're willing to part with their capital for a certain period of time, but they do want to get it back at some point. So the longer it takes you to get that back, the more worried they're going to be, and the more interest they're going to charge, or the higher piece of your business they're going to want in return for giving you this money. So it's a measure of the risk. So how long will it take you to hit break even? And then once you hit break even, how often will you stay at break even? Like if it's a seasonal business, you're selling toys, you know, you're going to hit break even, but then you're going to have a few months where you're not going to have break even after Christmas, and it'll take 3 or 4 months to build back up. So they're interested in all of that. Okay, sure.
To answer your question, I think I was to, if I want for a year, I mean,
Yeah.
I don't know that they need it for the 5 years.
We're probably at that.
Is there a certain competition that it's?
Yeah, so I'm wondering if it was set, if
And
it
it might,
was standard.
right,
They might have a standard expectation.
based on what they want in terms of the direction.
Yeah. One of the things that I'm finding my students' business ideas complicated, the break-even analysis, is that the examples that you're using in our textbooks, you know, that I come across, it's hot dogs, it's bicycles, it's something very simple.
Yes.
And a lot of their ideas have services, not products. And clients are being sold a service.
Mhm.
Client X gets this service, client Y gets this service, and so it varies quite a bit. How do you suggest they?
The way you handle that is, first of all, the analysis works for services. It just gets a little easier because you don't have any direct materials.
Right.
You have labor.
No manufacturing.
You have labor, and you don't have manufacturing overhead, but you do have overhead connected with providing the service. So you'll have direct labor, and then you'll have indirect labor and the other stuff, because you need to have an office, you need to have telephones, you need to have an internet connection. So those things are, some are
So
fixed
you're almost
costs and some
making
are
the
variable.
same distinction, because before we were looking at what's the cost of the product, now you're looking at what's the cost of providing the service.
And to get to your other question, which is what do you do if you have multiple services, is what you're going to end up having to do is you're going to have to estimate a sales mix. So let's say you provide 3 services, service A, B, and C, and each one is priced differently, and each one is expected to sell differently. To use break even, you have to be able to say for every 5 A services will on average sell 2 B services and 9 C services. Once you do that, you develop a selling price for that ratio of services, and that's your selling price. And then you do the same thing with the costs. Now, if your actual ratio among those changes, then your estimate's going to be off. But that's all you can do. And the reason for that is the fixed costs that are in this model are applicable to everything that you're doing. So you have to make assumptions about the variable cost and the selling price ratio and how it relates to that fixed cost.
And they can make the assumptions that those will hold constant, so that they're not trying to figure out from period to period how that ratio changes. They can state in their assumptions that they assume that that will remain the same. It gets very
Have
tricky.
everything in accounting, they have,
Right.
finance background, so there's a lot of gray area.
Yes.
Thank you so much.
Sure.
I have
Yes.
a similar question that I find that a lot of students get the math part, the break-even point, but even if they're doing a physical product, it's never as simple as a hot dog or bun where they could go out and easily find that information. So do you have any suggestions for where they can, if they're going to be manufacturing something that's technical in nature, like where do they go to find out?
In terms of identifying what their cost would be.
Yeah, yeah. I never
With
know what.
insurance, we can't find, we're stuck on estimating insurance costs. Like you said, companies don't want to just let go of it.
Yeah,
No, they
but
don't.
if you do look at some, the 10Ks, if you go online and look at some of the public companies' 10Ks and look at their financial reports, in the financial statements, you might be able to get some cost, then you're going to have to make assumptions about how those costs behave, yes. But at least you'd have an idea as to the different costs for that particular type of company providing that type of product or that type of service. If you search at Edgar, it's the SEC database, and you can, call up any of the public companies, 10Ks, and part of their 10K is their financial statement, their annual report.
Oh, I put it in.
And if you're interested in product pricing, there are some industrial supply houses that have prices for things like components and valves and things like that. Thomas, I think it's Thomas Ness is one. McMaster-Carr is another one. And
That's
W.W. Granger is another one. It's Granger.com,
Yeah.
Granger.
Oh, okay.
And they sell industrial supplies, floor cleaning equipment, valves, solenoids, relays, just all the stuff that goes into parts and pieces of manufacturing operations.
Well, our time is up. I believe your tour guide is here. So you have copies of the slides. You actually have the problem with the solutions as well, to play with. So it's been a pleasure, and I wish you good luck in your endeavors.
And thanks for your attention.